and this is really good news, is alternative minimum tax. Basically what happens is a separate way to compute taxable income. We compute the regular tax, we compute the alternative minimum tax, we subtract the two, and if the AMT is higher, the difference is higher, you pay that in addition to your regular tax. We call that the alternative minimum tax. Basically, we take your taxable income, we add back things like your deduction for state tax and some other things, and some people have large state tax deductions in California, and we then subtract a floor. That floor was the problem. In 2011, the floor was $74,000. In 2012, there was no fix. There was a fix in 2011. The fix is the floor is adjusted by inflation. There was no fix for 2012. The floor was set to drop to $45,000 for married filing joint. You can see that $30,000 at 26 or 28% would be a lot of money. The tax projections I ran in December for people before this was fixed were showing people paying $8,000 more tax on the same income they had in the previous year. It was going to be a big hit for a lot of people. Well, they agreed to fix it, and they fixed it for 2012, and they made the fix permanent. So in 2012, the limit is $78,000, and it's going to be adjusted for inflation from here on. We're not going to have this problem again. This is probably the best news, other than the depreciation rules, out of the tax laws. In addition to that, there were certain credits that are non-refundable. There are credits on our tax returns that are refundable. Credits reduce tax. They don't reduce taxable income, they reduce tax that we pay. Some credits are refundable, some credits are non-refundable. You can, with these new rules, use your non-refundable credits to reduce the alternative minimum tax. So that's another big thing that we got that is really going to help people. Some other provisions. Sales tax deduction, we were able to choose either the state income tax or the sales tax. We retain that through 2013. There's a required minimum distribution that people are required to take out of their retirement plans, their IRAs, when they hit 70 and a half. Some people don't need the money, but they're required to take it. They can directly contribute that distribution to a charity and get a 100% charitable deduction, and then they basically get an offset, and don't pay tax on the distribution. So that's a really good rule, and it's retained through 2013. There's some great education credits and education deductions that are on the tax returns in 2011. They're retained through 2017 for the credits. Also, there is another really important rule for certain people who are losing their personal residence. If you know people who are, and that residence is going to be repossessed and sold, and the debt is going to be canceled, that cancellation of debt is taxable income. There's a rule in this act that says that if you meet certain conditions, it will not be taxable to those people. So if they're losing everything and they lose their house and then they get a tax hit, now at least they don't have to get a tax hit through 2013. And then student loan interest, there's enhanced rules that they retain. Let's move into estate tax. Actually here, probably the last bit of good news that we got out of the tax rules were estate tax. Prior to this, estate tax was going to the right, to the left, up and down. It was difficult to tell. We had rules that were slowly increasing the amount of somebody's estate when they pass away that could escape estate tax. An estate tax is basically a tax on the value of your assets when you pass away. Whatever the value is minus the debts, there could be a tax. And that amount that you could subtract to be not taxable had been increasing, going up by law every year until it hit 2010. And then in 2010, there was a rule that says there's no estate tax. And then in 2011, it was supposed to go back to the limit from prior to these new rules, which was any estate over $1 million taxed at 55%. It's more than half. There was a special rule passed with the 2010 legislation that increased that limit to $5 million and took the estate tax down to 35% over it. That rule would expire in 2012, which means in 2013, people dying in 2013, their estates over $1 million would be taxed at 55%. They agreed to keep the $5 million limit. And they raised the tax rate from 35% to 40%. So instead of it going to 55, it went to 40, went up 5 percentage points, and we kept the $5 million, and it's inflation adjusted. Why is that important? Well, it's hard to get people to have estates over $5 million, or for a married filing joint couple over $10 million. So a lot more people are going to not have to pay estate tax, which is a good thing because then they can transfer wealth to the next generation. You know, take care of your kids, take care of your grandkids, things like that. Also, in addition to estate tax, the same limit applies to gift taxes. So you can gift cash, property to your children, and again, there won't be a tax. So $5 million is a much better limit. In addition to that, there's a way for a married filing joint couple with a $10 million total estate to set up a trust wherein when the first one passes away, their half of the assets go into a trust. The other spouse retains their half of the assets. When that spouse passes away, their assets escape $5 million. The trust already had $5 million, and so a $10 million estate escapes estate tax. In addition to that, they added in these rules, or they retained in these rules, a special rule that says if at the time the first spouse passes away, if you don't have $10 million in estate, so one spouse uses, let's say there's only an $8 million estate, and one spouse uses $4 million, and the other spouse retains the $4 million, the other unused $1 million can pass to the surviving spouse. So when she passes away or he passes away sometime later, if their assets had grown up to say $6 million, they could still get the whole 10. So that was retained in the law. A little esoteric, but kind of an important rule. So I think we got some great stuff in estate tax rules. Some great estate tax planning is going to come out of this if people haven't planned for this, and it's going to save a lot of people's assets to go to the next generation, to the generation beyond that.